So you've probably seen the headlines, right? Gold is absolutely soaring, hitting these crazy record-breaking highs. And then you've got Bitcoin, the supposed digital gold, and it's kind of just flat. Seems like a pretty simple story. Investors are running for safety. But what if that's not the story at all? What if we're all looking at this the wrong way? Let's dig in, because what's really happening is way more interesting.
Okay, so check this out. This is the puzzle right in front of us. Gold is on an absolute tear, up something like 50, even 60% this year alone. That's a huge rally. And then there's Bitcoin. It had a good run earlier, but now it's cooled off, giving back a lot of those gains. So just looking at this, you'd think, wow, gold is crushing it. But is that the full picture?
And that's where we get to the big question, right? Because if this was a classic flight to safety, everyone dumping risky stuff for hard assets, you'd expect to see it happen across the board. But we're not. And that's our first clue that something else, something much more interesting is going on.
All right, so let's tackle this whole flight to safety idea head on. Because as soon as you look at other big hard assets, the whole narrative it completely falls apart.
I mean, just look at the housing market. It's telling a completely different story. If people were really flocking to hard assets, you'd think real estate would be booming, right? But it's not. Realtor.com data shows active listings are way up, pending sales are actually down, and prices totally flat. Newsweek even called it a deflationary vortex. So it looks like this gold rush is kinda flying solo.
So what's the argument here? It's that this isn't some rational, calculated move into safety. No, it's pure uncut FOMO, the fear of missing out. People see gold's price chart going parabolic, up 50 or 60%, and they just pile in. They're just chasing the shiny object that looks like it's winning.
But here's a thought. What if we're using the wrong measuring stick for all of this? Let's look at a totally different way to frame this, one that completely flips the script.
This quote right here really gets to the core of it. Think about it. The US dollar is always being devalued, right? It's like trying to measure something with a ruler that's constantly shrinking. So what happens if you change the ruler? What if you stop measuring your investments in dollars and start measuring them against something with a truly fixed supply? What if Bitcoin is the real benchmark, the ultimate hurdle you have to beat?
And this chart just lays it out perfectly. Look, since January 2020, if you measure in dollars, the S&P 500 is up 100%. Gold's up 150%. You'd feel like a genius, right? But change the ruler. Price those same assets in Bitcoin. Suddenly the S&P is down 88%. And gold is down 84%. So while you think you're getting richer in dollar terms, you're actually losing purchasing power against the one asset that can't be printed into oblivion.
Okay, so while everyone's watching the gold price tick up, let's pull back the curtain and see what's happening in the background, because it looks like the smart money is playing an entirely different game.
This is wild. There's this really fascinating trend happening where governments are seizing huge amounts of Bitcoin from criminal operations. But here's the kicker. Instead of just selling it off, they're often just holding it. They're putting it into their own custody. And what this does is it creates this backdoor way for nations to stack Bitcoin without ever spending a dime on the open market. It's like this quiet, totally budget-neutral way of accumulating.
And it's not just governments, not by a long shot. The institutional floodgates are opening. Just look at this number, $100 billion. That's how much is poured into just one of the new Bitcoin ETFs, BlackRock's, in only a few months. This is not your average person FOMOing in. This is a massive, calculated shift from the biggest names in finance.
So you've got this huge split, right? You have the public glued to the headlines, chasing the shiny object, gold. And then behind the scenes, you have the biggest institutions and even governments quietly and systematically stacking the one asset in the world with true, verifiable scarcity.
So all of this leads to this really interesting theory about how capital actually flows through the markets. And it happens in a surprisingly predictable pattern. It's called the capital cascade. And if it's right, it tells us exactly where we are in the cycle.
Okay, so here's how it works. Step 1. Central banks turn on the money printers. Quantitative easing. They flood the system with liquidity. Step 2. The old money mindset kicks in. They see inflation coming and they do what they've always done. They buy gold. That's where we are right now. Then comes step 3. All that new money has to go somewhere, so risk-on appetite comes back, and you see money flow into stocks, the NASDAQ. But the final step, the end of the line for this capital cascade, is Bitcoin. That's where the smart money moves when it's looking for the absolute hardest, most scarce asset.
And that brings us to the absolute punchline of this whole idea.
If this capital cascade theory is right, then this huge gold rally we're seeing right now, it isn't the main event. It's just a warm-up act. It's the starting gun that tells you the real bull run hasn't even begun.
So, why Bitcoin? Why is it the final stop on this journey? Well, it all comes down to its core design. You could say Bitcoin was literally engineered from the ground up to outperform everything else.
Let's just put them head to head. Gold supply? Yeah, it's scarce, but we're always finding more of it. Bitcoin's supply? It's absolutely mathematically fixed at 21 million. End of story. The gold network, it needs banks, vaults, governments, a whole system of trust and middlemen to work. Bitcoin is the network. It settles transactions on its own, without asking anyone for permission. Gold needed centralization to go global. Bitcoin was built decentralized from day one.
Yeah, but what about the volatility, right? Everyone says Bitcoin is so volatile. But here's the thing. Volatility isn't the same as risk. Risk is you losing your money forever. Volatility is just the price moving around. And for an asset with a fixed supply, it has to be volatile. When more people want it but no more can be made, the price is the only thing that can move. In fact, that volatility is the very reason it's been able to grow at an average of 100% a year, while gold just chugs along at 2%.
So it really boils down to this. Greed chases gold. It's simple, it's shiny, the chart goes up. But understanding what real scarcity means in our digital age, that's what chases Bitcoin.
And that leaves us with one final pretty powerful question to think about. The big institutions, even governments, they're already stacking. So when, not if, but when, the rest of the market finally catches on and shifts its focus from the shiny object to the truly scarce one, what happens then? When everyone rushes for the exit and there are only 21 million seats on the lifeboat, things could get very interesting very fast.